Hello and welcome back to Channel 11. Today is Monday, March 4th, and it's the February review I called Good Times, Bad Times after a great Led Zeppelin song. And I picked it because we're getting a lot of mixed data, some coming in good, some coming in bad. Questions about recession last year, soft landing, no landing this year. And the equity market sure thinks no recession as we're hitting all-time highs on some of these indices. Let's start off with fixed income. This is February returns for fixed income. We see negative returns for rate assets or high-quality assets on the far left, down about anywhere from 1 to almost 2% for agency mortgages. The assets that kind of lagged corporates are doing a little bit better this year. You can see IG in the beige is down about 1.5%, and the securitized credit sectors, some of them are positive on the years. Even some of the fixed rate securitized assets are positive on the year. Non-agency CMBS AAAs, those are fixed rate, so those are down a little bit more, but still outperforming investment-grade corporate bonds that are at very tight spreads. Risky levered credit, floating rate, still the place to be, with CLOs and levered loans seeing positive returns again. I think this is year 3 or 4 now that it's been the place to be, floating rate debt. On the far right, you can see the index down 1.4%. This is, again, just February returns. So as we look year to date, those high-quality parts of the market, treasuries, agency mortgages, are still in the negative. -2 for agency mortgages, worst performing part of the index. And IG corporates down 1.7 in the beige. And all that securitized stuff that lagged the corporate market is positive on the year. Not by much, but positive on the year. The top performing thing on this, or sector on this chart is CMBS, which was last year's big laggard, playing catch up with very wide spreads to start the year. Our What Looks Cheap report across those indices we just looked at, or some of those indices we just looked at, the lower the dot on the screen, the more expensive these assets are. It means they've done well and the spread is tightened. Investment grade corporate bonds, EM and high yield, all the way at the bottom, around 10th percentile, which means they've only been more expensive 10% of the trading days over the last 10 years. And at the very top, you can see one of the laggards this year, agency mortgages, having widened from the beginning of the year, but off the wides we saw last year, at one point that was all the way up at almost 100th percentile or 99th percentile, and now you can see it's low 91st percentile. So definitely one of the cheaper assets still out there relative to its own spread history, relative to corporates. It's just going to take time for that spread to come in as it plays catch up to corporates. We need the buyers to come back, the banks and the money managers that are the next marginal buyers there. The securitized sectors, you can see, have played catch up. They were kind of in the mid-80s, 80th percentile a month or two ago, and now they're starting to move down this chart as they play catch up with the credit markets. We talked about that last month. We looked at these charts that show the relative cheapness of these securitized sectors relative to corporates. And the reason I think that these assets have been trading kind of wide to corporates is the money that buys them is not index fund money. It's actively managed bond funds and separately managed accounts, and they had been in outflow mode. And so we really need the monies to come back into the bond funds and for these spreads to really tighten back in. But you can see that they're playing catch up, especially in the top left, CMBS. You can see that blue line is moving down. Now, this is a relative cheapness. Just because the line is going up doesn't mean that spreads are widening. It could be that corporates are tightening faster than these assets are, but you can see that they're starting to play catch up, and that's why you saw in the previous return chart that the securitized sectors are positive on the year relative to corporates. Part of it's duration, but part of it's also the spread. Now, even though spreads are on the tighter end in some of the sectors, especially IG and high yield, the all-in yields are still on the higher end, obviously off their highs of last year, but you can still get kind of mid to high fives buying investment-grade corporate bonds. You can still get kind of 6 to 7% yield in the securitized sectors for relatively short duration. On the far right, CLOs, floating rate, 6% yield for investment-grade bonds. So this is still very interesting all-in yield levels in the higher quality parts of fixed income. And look at the riskier parts of fixed income, albeit high yield has come in a lot on a spread basis, the all-in yield is still in the 8-ish area on the index. And you can see that on the double Bs down in the 6+ range, into the far right or across the right, you can see the different securitized sectors. Still kind of like 9, 10, 11, 12, high single-digit equity-type returns. So still something to look at and consider is credit for your portfolios, high-quality fixed income as a diversification for equities. I know equities just seem to never go down. We're on some historic streak, I think, of like 16 straight weeks of positive return for equities. But at some point in time, something will shake things up and you'll want some fixed income in your portfolio. Let's talk about rates. Rates had a strong rally off the dovish pivot in the fall of last year. I was getting emails from people sending me like Twitter notes from Twitter notes about why rates are going to infinity and never coming down. And of course, that was the high-end rates. We got a pretty significant rally, and with some inflation surprise to the upside, with some growth surprise to the upside to start the year, you've seen rates kind of correct here. And big correction on the front end off kind of the crazy, 150 basis point Fed cuts this year expectation that I thought was way overdone at the beginning of the year. And now we've kind of normalized back to basically what the Fed's telling us, which is, about 3 cuts. And so, I have some interesting slides here from JP Morgan, and this goes back 50 years and looks at different hiking cycles. And basically from the last hike, which happened for this hiking cycle in July of last year, on average, going back through all the hiking cycles, going back 50 years, that usually it takes at least 12 months before they cut on average. So that would put us in the summer of this year, which I think makes sense, especially given what the Fed's been telling us, and also some of the more positive inflation data and strong economic data that's come in very recently. And so I think that's kind of the base case right now for the marketplace. So when we see a soft landing, usually they don't cut that much. In the mid-'80s, they cut 200 basis points during that recession, 84, 85. During that soft landing, 84, 85. And, 200 basis points sounds like a lot right now, but base rates were much higher there. So they were cutting 200 basis points when rates were in the teens back then. And in 94, when we got the soft landing during that hiking cycle, the Fed cut 75 basis points. Well, guess what? That's kind of like what the dot plots are plotting out for this year. So I think for now, if the data keeps coming in strong on the economic front, then, we'll see less cuts, kind of maybe what the Fed dot plots are telling us. But if things slow down, although I know it seems like it's impossible right now, but given where equities are, but there is still weak data coming in on the manufacturing side, and we'll look at some of those slides shortly. If that data slows down, then I would expect, and we see a harder landing, I would expect more than, more than that 100 basis point, 75 basis point rate cut. So what JP Morgan is saying is the inflation has moved down, and a lot of it has been core goods, right? All the supply chain issues and the ships backlogged outside of Long Beach Harbor here in LA. And the danger is that core goods picks up again because of maybe what's going on in the Middle East and shipping routes, maybe because, input prices are going up, maybe because demand starts picking up again. And they've noted that while core goods had been continuously declining through much of 23, it's kind of flatlined and it ticked up a little bit. And so that is why I think that break-evens have also ticked up a little bit, the 2-year break-even especially. But since just the 2-year has moved, it's really kind of more about the near-term pickup inflation and maybe the Fed staying higher than the market had initially expected. But watch these longer tenor inflation expectations. If they move up like they did through the end of 21, 22, that is not good news for broad markets, not just bonds, but for, I think, the risky assets that have done really well very recently. So keep an eye out on these break-even inflation rates. So let's go back to core goods. Kind of a noisy chart, but I think it's a good one. The orange is consumer good input prices, right? The input prices to things being made. The solid blue line is PMI output prices for goods. And the dotted line is Chinese import prices. So what they're showing is that, look, there's the story out there for a while was like, look, China's slowing. And so with weaker China and global growth, there's going to be just this disinflationary pressure globally. But what's happening in the very near term is that you've seen this sudden spike in import prices for consumer goods. That's that orange. It's pretty dramatic spike. And usually that comes along with output prices also going higher. And so there could be this near-term pressure on core goods, and you'll see a pickup in core goods inflation again. And the Fed maybe is not going to be able to hike. And this has been kind of a pickup in growth, right, that we've seen. So what's interesting is that this is from Morgan Stanley, is that the bond market's kind of pricing in this risk. You look at the blue line on the top, that's the change in Fed funds. They're basically saying that, it's higher for longer. The 10-year yield has also gone up. In fact, the entire curve has kind of reversed some of the rally that it saw, assuming that the rates will be higher for longer. But the equity market has not really repriced this at all. Maybe the equity market's looking further out and saying, okay, the cuts are still going to come, but they're just pushed out. But as far as the risk of this kind of higher for longer, it's being priced into the bond market, but the equity market seems to not care about it for now, or it's just looking further out in time and saying it's still going to happen. It's just pushed out a little bit. So I guess we'll have to wait to see who's right on this. All right, so now looking at equity performance, it is been on a tear. Nikkei up 17 on the year, NASDAQ up 7, solid single-digit type returns across the marketplace. The U.S. yet again, kind of the place to be, leading the charge outside of the Nikkei, which has made a new high. And as we look down across the sectors, it's that kind of that tech and momentum leading the way. You can see up 18% from momentum, and tech is really the place to be, those mega cap tech stocks. But very recently, it seems like we've seen some broadening out of the market as some of the laggards of the equity market start to play catch up. Commodities, kind of a mixed bag. Industrial metals, copper, agriculture down on the year, energy up. And so depending on what index you look at, the Goldman Sachs commodity index is up on the year. I think that has more energy in it, nat gas, and then the Bloomberg commodity index is down on the year. But really, it's been kind of a weak market for commodities. You can see that big push up in 2021, 2022, and then it just hasn't really been able to catch a bid for most of 2022, 23. So we're kind of neutral right now on commodities. We'll have to see what happens with global growth. And it's interesting that it continues to be weak. That's definitely positive on the inflationary front. And I think this is because global growth is, while it's not as dire as it was maybe a year ago, I think global growth expectations, especially out of China, are low. I think that's what is causing the commodity weakness, is really that slowing Chinese growth. The dollar has been trading range bound with the rates. As rates go higher, the dollar really has been following it. So you've seen some dollar strength with rates coming up here. And I think rates will continue to dominate the dollar's movements in the near term. So good time, bad times. Let's look at the far right of this chart. This is like consensus economist predictions for real GDP in the U.S. And you can see that as we got into kind of the start of the rate hikes in 2022, real big fears of recession, very high conviction from many economists that we'd see a recession, and that's really improved a lot. And the green line is 2024, and you can see that it's just been a consistent move higher from the middle of last year. And the market just, the economists at least, don't think that we're going to see much of a recession in the near term. So one of the things that has been really recessionary is LEI. So we're going to dig deeper in LEI, leading economic indicators. You can see that usually when this dips down into negative territory, that's followed with real GDP contracting and falling down and us going into a recession. If I took this back further, you'd see the same thing, and you can see LEI on the far right. It's been in the red for a very, very long time. It seems like almost the same amount as it was during the global financial crisis, yet we never really dipped down into that recession territory with real GDP. So let's look at the different parts of LEI. It's comprised of a couple different things. ISM new orders, so new demand for goods and in manufacturing, and manufacturing has definitely been weak. Leading credit index, this is something that is proprietary that they put out, and one of the biggest inputs there is the senior loan officer survey and margin lending at banks, and that's, the banks have been pulling back. The interest rate spread, 2s10 spread, been negative for quite some time. Consumer expectations also been poor, and so all those things have been in the red, which is why LEI has been in the red. But maybe the economy is less manufacturing sensitive, maybe it's less interest rate sensitive, and that's why we've been holding on out there. So this is PMI new orders. It's not a perfect indicator, but you can see that during recessions it dips pretty negative. It has gone negative in the past. Without a recession, the mid-90s was that soft landing time period. You can see also a blip kind of in 2011-12 when we had that European crisis causing a slowdown. Again in 15-16 when there was the energy crisis, and you saw spreads blow out in credit assets. And like at 22-23, we went pretty negative for a good amount of time. It looks like almost 2 years, but it's been moving up. So this number flipped positive for the first time in almost 2 years. It's gone back negative, but the trend has been up. So something to look at and keep your eye on. Consumer expectations also deeply negative, but moving higher as things seem to be getting better out there. And look, again, something to keep an eye on. This stuff, it looks like it's trending in a more positive way. The interest rate spread obviously not making much headwinds. We're kind of still inverted there. And leading credit indicators, again, this is not a great indicator because you can see there's plenty of times when it's in the red and we don't see a recession. And but again, these are the different components of LEI. So I think the takeaway is that the economy maybe has changed, especially in this post-COVID turnaround where you had a lot of fiscal stimulus coming in. You had the stimulus checks go out, so the consumer has kind of held in there. So while the blue line manufacturing PMI has been negative, and it just surprised to the downside last week, that services PMI has kind of stayed resilient. And that is a large part of the economy, is that services component of the economy, and that's been holding up. And so if you see the manufacturing start to pick up again, then we could maybe be in a recovery mode for the economy and crisis averted. So we've got to respect the data. A lot of the data had been pointing to a recession, but very recently there are some indicators that there could be at least a near-term pickup in growth. Look at the city economic surprise indicators. U.S., Europe, and China all kind of moving upwards, had been deeply negative through in the middle of 2023, which is kind of when we, I think, had peak pessimism in risk assets, and those have been moving and marching higher. Global manufacturing services and manufacturing PMI are ticking up as well, and the blue had been the manufacturing had been in the negative or sub 50 for quite some time, actually the longest in history. This came from our Between the Lines on LinkedIn. Sam Garza and team put together some great slides. I have it on LinkedIn. Please follow them. And this shows you consecutive months in contraction, sub 50. This was the longest period going back here through 1998. And what happens when global manufacturing PMI exits contraction, and we'll have to wait for more than one data point to see if this is going to continue, if January was an anomaly. But after that happens, global equities tend to perform well on average, plus 8.9% versus plus 4.8% trend since 1998, with positive returns in 4 out of 5 episodes. U.S. large cap and small cap equities do even better, plus 10.8 and plus 15.7 respectively, when that number flips positive and stays positive. U.S. fixed income also does well, with the U.S. aggregate bond index plus 5.4%, corporate high yield plus 8.4, both above trend since 1998. So check out this data on our Between the Lines, and it shows you that some interesting charts out there. And this one struck out to me that you saw manufacturing PMI globally finally tick up. So good times, bad times. We've got some good data. We got some bad data. It seems like some of the data is getting better, And that is something to watch out for and think about as we think about asset allocation. So thanks for your time. I hope you guys enjoyed this month's episode, and we'll see you next month.